It wasn't a technical glitch. It wasn't a momentary lapse in investor sentiment. It wasn't even a standard market correction. It was the mathematical inevitability of a trade war in a leveraged world. 145%. That is the tariff number that sent shockwaves through the global financial architecture. $2 trillion in American value evaporated. Not slowly, but in a violent, downward repricing. At the exact same moment, capital did not just vanish. It moved. It migrated. Chinese equities surged over 5%. The divergence is stark. The arithmetic is merciless. We are witnessing a mechanism that has played out for 3,000 years. The pattern is unmistakable. When a dominant power attempts to wall off its economy to protect its leverage, it often accelerates the very decline it seeks to prevent. Incentives shift. Capital seeks the path of least resistance. Efficiency dies. Costs rise. And the market punishes the aggressor. This is not about politics. This is about structural economics. History provides the blueprint. We have seen this specific sequence of protectionism, retaliation, and capital flight before. The names change, the currencies change, but the behavior of human beings under financial stress remains constant. To understand why $2 trillion disappeared, we must look at the empires that tried this before. Consider the Spanish Empire in the 16th century. Under King Philip II, specifically around the bankruptcy of 1557, Spain was the master of the world. They possessed the silver of the Americas. They commanded the most feared infantry in Europe. But the costs of empire were unsustainable. Wars in the Netherlands and the Mediterranean drained the treasury faster than the galleons could replenish it. The Spanish crown turned to protectionism and rigid trade controls. They attempted to hoard bullion within their borders, restricting the flow of capital to maintain dominance. The incentive was to force the world to buy Spanish wool and oil at dictated prices. But the market found a way around the walls. Dutch and English merchants, operating with lower costs and freer capital markets, began to undercut Spanish hegemony. The result was the price revolution. Inflation inside Spain soared. Domestic industry, shielded from competition but starved of innovation, collapsed under the weight of high costs. A merchant in Seville, watching the silver coins in his ledger buy less and less wheat every month, realized the hard truth. The wealth was illusory. Capital fled to Amsterdam. The Spanish middle class was priced out of existence, crushed between the hammer of taxation and the anvil of inflation. Just like the Spanish Empire, the British Empire faced a similar reckoning in the 20th century. By the 1930s, the sun was setting on British industrial dominance. The costs of the First World War had been exorbitant. The pound sterling was under immense pressure. In an attempt to preserve the empire's economic integrity, Britain turned to the imperial preference system following the Import Duties Act of 1932. This was a tariff wall wrapped around the empire. The goal was to prioritize trade within the British sphere and lock out competitors. Like the United States and Germany, the logic seemed sound to the politicians in London. Protect the domestic worker, shield the domestic factory. But the unintended consequence was a loss of competitiveness. British industry, insulated from global pressure, failed to modernize. A dock worker in Liverpool in the mid-1930s might have kept his job temporarily, but his wages purchased fewer goods as the cost of imports rose. Global capital began to view the sterling bloc not as a fortress, but as a trap. Liquidity moved toward the rising industrial power across the Atlantic. The protectionist measures meant to save the pound ultimately contributed to its displacement by the dollar. Just like the British Empire, the Weimar Republic in Germany offers a darker, accelerated version of this dynamic. While often cited for hyperinflation, the trade isolation of the early 1920s was a critical catalyst. Germany was saddled with reparations and stripped of productive territories. In 1923, when French and Belgian troops occupied the industrial heartland, it created an effective trade blockade. The German government responded not with production but with printing. They attempted to subsidize the striking workers and the frozen industries with newly created marks, The tariff barriers, both imposed by victors and retaliatory by nature, shattered the supply chain. The disconnect between the volume of currency and the availability of goods became absolute. A clerk in Berlin didn't just worry about the price of bread. He worried about the availability of flour. The internal value of the currency collapsed because the external trade mechanism was broken. Those with capital didn't wait for the bottom. They bought foreign currencies, gold, or even pianos, anything that wasn't the paper mark. The flight from the currency was total. The pattern repeats in 7 distinct stages. Stage 1 is the era of peak dominance, where the hegemon controls global trade routes and sets the reserve currency, allowing it to run deficits without immediate pain. Stage 2 is the accumulation of structural costs, usually driven by military expansion or social entitlements, which begin to outpace productive growth. Stage 3 is the protectionist pivot. Facing competition, the state enacts tariffs, sanctions, or capital controls to ring-fence its economy, believing it can legislate prosperity. Stage 4 is the retaliatory spiral, where trading partners respond in kind, fracturing global supply chains and raising costs for everyone. Stage 5 is the domestic price shock, where the cost of goods rises due to tariffs, while the currency weakens as foreign demand for the hegemon's debt evaporates. Stage 6 is the capital flight, where investors, sensing the structural weakness, move liquidity to competing markets or hard assets to preserve purchasing power. Stage 7 is the structural fracture, resulting in a new economic equilibrium where the former hegemon possesses a smaller share of global wealth, just like Weimar Germany. The United States today is flashing the warning signs of Stage 4 and Stage 6 simultaneously. The imposition of a 145% tariff is a historic escalation, while the stated goal is to protect domestic industry. The immediate market reaction reveals the flaw in the logic. $2 trillion of value did not just vanish. It repriced the risk of holding U.S. assets in a trade war environment. The 5% surge in Chinese stocks suggests that global capital is hedging its bets, moving into markets that are currently undervalued, and positioning for a shift in trade flows. The incentive for global investors is no longer blind loyalty to the dollar system, but survival. When the cost of doing business in the primary market becomes prohibitive, liquidity flows to the secondary market. There is a counter-argument often presented by policymakers. They argue that these tariffs are necessary leverage to force fair trade practices, and that the market dip is a temporary adjustment before a resurgence of domestic manufacturing. This view assumes that the United States exists in a vacuum. However, economic history suggests that in a globally connected system, the consumer pays the tariff and the exporter finds new markets. The risk is that by forcing a decoupling, the hegemon accelerates the development of alternative financial rails that bypass its control entirely. Under these constraints, the rational move for major capital allocators is to diversify away from the combatants. The endgame approaches in one of 3 ways. The first is a controlled decline, where policymakers recognize the era, negotiate a de-escalation, and accept a multipolar trade world with lower growth but stability. We saw glimpses of this in the post-1970s adjustments of the British economy. The second possibility is a chaotic collapse, where the trade war triggers a sovereign debt crisis, as foreign nations stop recycling their surplus capital into U.S. treasuries, forcing the Fed to monetize the debt and ignite inflation. The third outcome is a reset and restructure, often following a period of intense volatility where a new global monetary agreement is forged, much like Bretton Woods, but with a basket of currencies rather than a single anchor. The only variable is timing and pain. Subscribe to this channel. Prepare your mind by understanding the data, not the headlines. Resilience comes from recognizing the pattern before the cascade begins.